Hello, everyone. Today on the Final Bar, we'll talk about this market back in a choppy phase, really in a distribution mode as we move further and ever onward to the downside. A lot of choppiness, but resolving more to the downside at the close, with the S&P closing around 4,300. Today, we'll hit the market from three directions. We'll talk about the big picture environment, charts of the S&P, charts of gold starting to improve, and cryptocurrency is doing quite well. What's not doing well today, consumer discretionary with the three biggest names down. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using a lot of charts, focusing on the message the markets provide back to us in the form of price, breadth, sentiment, trend, momentum, all those ways we can measure what investors are doing. Collective movements of investors as they make their buy and sell decisions aggregated into price behavior. And that's what we'll focus on in this show, and particularly today. Sort of a choppy environment, or a choppy day among many choppy days. One of my guests last week, Sean McLaughlin from All Star Charts, called it a sloppy chop, I think was the phrase he used to describe this market. And we're sort of getting more of that again, before the long holiday weekend, but now coming out as well. Bit of a bounce in the afternoon, but continuing to show signs of distribution. And, again, while the movements on any particular minute, any particular day are in a lot of ways honestly unpredictable for all intents and purposes, we can make educated guesses about where things are headed using the technical toolkit. And I would argue we've been in a distribution phase here. We're seeing a lot of signs of distribution in the form of breadth deterioration and momentum deterioration. We'll look at some of those charts here in a few moments. We have great guests on the show. Today's a little bit different, but we'll have guests on Wednesday and Thursday of this week. On Wednesday, the 23rd, we have Tim Tashler from Sprott Global joining us. On Thursday, the 24th, we have Todd Sohn from Strategas joining us from New York. Two really good guests for you. On Thursday, by the way, is our latest episode of The Pitch. My friend Grayson Rose here at StockCharts.com will moderate a discussion with John Kosar from Asbury Research, Tony Zhang from Options Play, and Mark Newton from Fundstrat Global Advisors. Should be a lot of fun. It's a really cool show. We have a lively discussion with each presenter giving you 5 picks, and then they discuss them as a team. Go to StockCharts.com/thepitch for more information on that upcoming event. Let's continue on today's show with our market recap. As I mentioned earlier, we've got sort of a choppy move today with the S&P closing just right around 4,300, sort of distributed in the last hour. And a lot of times we think of that last hour as sort of a telling sign of where things are headed, in terms of where institutions are positioned, to be honest with you. And so that distribution that we have in the last hour is worth noting. That's something to certainly pay attention to. On Friday of last week, where we didn't have I actually didn't do a live show, but Friday of last week, it was a choppy tape, but sort of in the last hour, again, you had that distribution. So days or series of days where you have distribution in the last hour is usually not an encouraging sign. The S&P closed down about 1% from Friday. NASDAQ was down 1.2%. That's using the NASDAQ composite. Mid caps and small caps both down more than the S&P. And if you look at what lagged today, it was consumer discretionary, it was energy, it was materials, and particularly energy. You'll have and materials as well. You have more of a weight in the mid and small cap indexes usually than the S&P, and that's part of why that's not looking as good as the others. The VIX, by the way, is nearing back 30, coming up from below. It's down to almost 20 not too long ago, but volatility is certainly becoming more and more elevated. Quickly looking at some other markets, it was a choppy day for bonds, for fixed income, and for quite a while during the course of the day here, it looked like interest rates were coming off going into the afternoon, and bond prices were going higher, sort of an indication of people rotating into the fixed income side, but that's sort of alleviating going into the close of the 10-year yield, ending the day around 1950. The dollar index, by the way, is flat, and that's using the UUP, which is a bullish dollar ETF. Gold pushing higher today, choppy as most things were, but finishing about 0.2% higher. Silver up 0.9%. Oil prices continuing higher. Now, obviously, a big part of the headline risk that sort of played out over the last 24 hours was news from the Ukraine, Russia, and Western countries all sort of having an extended debate about what was happening in Ukraine, sanctions coming out, expectations of what those sanctions might be, the prospect of future sanctions. In general, I was asked recently what would unrest in Ukraine or potential conflict do, and the two general thoughts you would have would be higher oil prices. That tends to be a pretty safe bet when you have any sort of conflict in a region which is known for oil production. And then the other side is, in general, that would probably net out to a weaker equity market. Now, the interesting thing is you have this all happening while there are a lot of other competing headlines as well. So, you have obviously interest rates, you have the Fed meetings coming up, you have Fed governors being quoted talking about the prospect of a more aggressive rate hikes, and all of that, along with what's happening in the Ukraine, has the potential to impact stocks. Bitcoin and Ethereum and the other 8 of the top coins that we track all up today, with Bitcoin up 2.7%, just above 38,000. Let's look at a chart of the S&P 500 here and see where things are at. So sort of an interesting day. Every time I refresh this chart, the chart sort of looks a little different. It was a great reminder to not worry too much about the current price bar, particularly when you're looking at a daily chart. We highlight on StockCharts that bar if it's active, and depending on what pricing source you're using, what data you have, if you're using real-time data or not, the bar will be highlighted with a different color. But anytime there's a little shaded bar on the current bar, that means it's actually an active bar. And I would always remind people, when the final bar is highlighted, you don't want to draw too many conclusions based on that, because it's an active bar, right, or an active candle. Things are actually fluctuating real time. What's very interesting to me is we closed just above 4,300. That is a new low close for 2022, right? We traded lower in the end of January, but we never closed this. So it's actually a new closing low. We did not undercut, I don't believe, the closing low from back here from early October of last year. And if we did, it was like really, really, really close. Not meaningful enough to make it obvious that we had done so. So I think we got a little bit of a lower close there in October. My point of bringing this up is we're sort of there, right? If you're thinking of the potential head and shoulders top, and as I was talking with some people on social media earlier today, this is not an ideal head and shoulders top. So a lot of times with price pattern, there's sort of the idealized pattern that if you look up the Edwards and McGee book or the John Murphy book or the Martin Pring book, they will have this perfectly valid, beautifully, idealized head and shoulders pattern and shows what to do about it. In reality, the markets are often not that pretty, and that's sort of what we're seeing here. It's sort of this whole top area is kind of a head-ish thing. And then you have the clear left shoulder and the clear right shoulder. It's sort of skewing off to the right here, which is a little, less than ideal. But overall, you have a high surrounded by lower highs. And that's the essence of the head and shoulders pattern. That's why Elliott wave analysis involves that idea of a trend that goes to a certain degree, and then all of a sudden the lows and the highs tell you that something is different. So when you have a lower high, which we clearly did around 4,600 here in early February, you then look for a new swing low. On a closing basis, we've now broken the trend line, taking the lows, the closes from October and the close from late January. On an intraday basis, we have not done it yet. It's actually down here, sort of the 4,150 to 4,200 range. We'd have to get below 4,200 to really complete that head and shoulders top using the intraday data. All of that being said, we're certainly showing renewed weakness over the last couple days, sort of Thursday, Friday of last week, pushing off the 200-day moving average and rotating lower, and now we're in that shaded area. And I sort of have highlighted 4,200, 4,300, that's from the previous lows, and the first Fibonacci support level. We're in the sweet spot where if this is just a buyable dip among many buyable dips, this is about as low as I think you can go and still argue that with any legitimate technical justification. We get below 4,200, and this is something very, very different than what we've seen previously, I would argue. We're going to talk to, who are we talking to later this week? Tomorrow, we're talking to Tim Tashler from Sprott Global. When he comes on the show, we usually talk about gold. I'm hoping we're going to be able to go there tomorrow, so I won't talk too much about the GLD, but I'll reserve that for talking with Tim about it. But certainly this rotation, I think, has happened, right? We've had this choppy environment for gold for quite some time. Gold has not been much of a safe haven at times when you think it might have been. And when inflation has become more and more obviously chronically negative, right? When you have growing inflation concerns, gold is usually the safe bet to rip to the upside. It hasn't really happened until the last couple trading sessions, and now you're seeing the GLD break above fairly well-established resistance, and now it's overbought or just coming right at that overbought level with an RSI just below 70. And my question for Tim is, what's the profile from here? Do we have enough juice to get above that last Fibonacci support resistance level and push on to new highs for the last 12 months? Or is this just the latest rally among other failed rallies that we've seen previously? So a lot of question marks, I think, on that chart for sure. The last macro chart I'll highlight for you is interest rates, looking at the 10-year yield. Not that one, this one. $TNX is the best way to follow yields. I would argue 10-year yields on the StockCharts platform. This is an index that comes from the CBOE, and it's a good representation of interest rates using that middle of the yield curve, sort of the sweet spot of the yield curve. All in the last year and a half, I've been asked how high could yields go, and my first answer usually cynically is a lot higher, right? I mean, there's no potential, there's no real upside definition of where yields could peak out. I mean, they could certainly go further to the upside. And now we've certainly seen a consolidation of quite some time for much of 2021. I think resolving back to the upside. What's interesting is bonds have rallied here as stocks have become a little more choppy. So rates have come off. My question, and I think my assumption is that rates continue to go higher. Overall, that tends to favor more of the value-oriented cyclical sectors, particularly the cyclical sectors like financials, like energy, and some others as well. Let's continue on to our next segment called Sector Setups. We've talked about the market environment. We now rotate to looking at the 11 S&P sectors. What I like to do to start with this is looking at the RRG. This is Julius de Kempener's creation years ago, and I've known Julius and followed his work for a long time. And the first time I saw this, I thought it was just a brilliant way of visualizing the 11 S&P sectors rotating around the benchmark in the middle there, the crosshairs. So if you look here, we're looking at weekly data, so it's a little more of a long-term view at the 11 S&P sectors. You have the S&P at the crosshairs there in the middle, and we're looking at how they're rotating. Further to the right means outperforming, further to the left means underperforming. Higher up on the y-axis means the momentum is improving. Further down on the y-axis and the momentum is deteriorating. We see how things rotate in sort of that clockwise motion. Look at how the energy sector, the XLE, pushing further and further up and to the right. So even though there's been some choppiness, even though a lot of those names have had really good runs and have pulled off a little bit, there's no denying that those are in a position of strength and certainly seeming to push further up and to the right. So energy remaining the strongest of the 11 S&P sectors using the weekly RRG. You know what's second to that? It's consumer staples, which might be a bit of a surprise. But we're going to look at Kraft, Heinz here, KHC, a little bit after the break as we get into some of the stocks that are shifting around. And Kraft Heinz is one of those consumer staples names. A pretty decent chart, reporting earnings this week, if I remember, or maybe just popped up on the strong performers list today. I think that's actually where I got that from. Financials, I would say, arguably now number 3, the XLF, which is now overtaking utilities. And so those are your 3 strongest sectors using the weekly RRG data: energy, consumer staples, and financials. The growthy stuff, sort of the traditional offense, what many investors, I would argue, particularly younger investors, think of as the market: technology, consumer discretionary, communication services. These are all things that actually score relatively poorly using the RRG methodology because, again, they've been underperforming. And even though they've had some bounces, there have been some meaningful bounces in some technology names, in some consumer names, and certainly in communication services stocks that have been beaten down for quite some time. The RRG is telling you to continue to lean away from those sectors until the evidence proves otherwise, until those trends start to reverse. You know, we often talk about consumer discretionary versus consumer staples, thinking of that as offense versus defense. And you can see them from the top left. We have communication services, then consumer discretionary, then consumer staples. Look at those 3 sectors and look at how each of them have had a very different return profile over the last year here. We're looking at 1 year of data and really focus on the last 6 months if you could. Communication services actually peaked in September of last year, and for the last 6 months have just been deteriorating consistently. This is the only one of the 11 S&P sectors that's actually not true. Yeah, it is. It's the only one of the 11 S&P sectors below 2 downward sloping moving averages where the 50 is below the 200-day, sort of a classic bear market profile. Communication services is the only one showing that particular look right now. The rest of them are all in varying phases of a rotation, and industrials are really close to looking a lot like that, but not quite there, certainly seeming to accelerate in that direction today. That's your first chart, communication services. Now look at consumer discretionary. You can see it peaked out a little bit later. So while communication services peaked out in September, consumer discretionary peaked actually in late November, although it had a number of times to try to get above 210 on the XLY. From there, clearly rotating lower, breaking below the 200-day, testing that from below, and now rotating back to the downside today. And if you're looking for weakness, certainly consumer discretionary, the weakest of the 11 S&P sectors, sort of the three biggest names, Home Depot, Tesla, Amazon, all struggling. And that it's hard for a sector to do anywhere near respectively when the three mega cap names, which make up probably 50+% of the ETF, all down fairly significantly today. That's your second chart. Now look at your third chart, which is consumer staples, and you can see why it scores so well on the weekly RRG. Because if you look at the last 6 months, this is probably one of the better setups that we've seen in terms of an overall move higher. It's given back some of those previous gains, but it's more in a consolidation phase, right? You see more of a coil pattern of lower highs and higher lows. Let's zoom into this just for a minute. You can see what I mean by a coil pattern. You could call this maybe a pennant pattern, depending. It's more of a, I think that's more of just a vernacular choice, to be honest with you. They're similar in terms of how you think about them. It's just more the time frame that you're looking at that would differentiate those two. Consumer staples, as with most sectors, have had a pretty good run from the March 2020 lows, but you can see for much of that time, consumer staples underperforming because while everything was pretty much going up, other sectors were just going up a lot more, right? They were outpacing the S&P on the way higher, while something like consumer staples was underperforming, going up, but not as much as those other sectors. All of that changed in November of last year. And when I often talk about how the market topped in November, what I mean by that is that the market experienced a change of character, I think, starting in November. From November on, the breadth picture looks very different. The momentum picture looks very different because you were making new highs on stronger momentum in November. From that point on, we've been making new highs on weaker momentum, which I think sort of was an early indication or a very meaningful indication of potential price weakness that we're still dealing with. Now, though, if you look at, and also I would say another point is the fact that consumer staples have actually outperformed from mid-November to where we're at. The relative strength has gone from consistently lower to consistently higher. Now we have this coil pattern, which is a run higher, then lower highs, higher lows. You have a narrowing of the range, sort of an equilibrium that we're coming to. What's interesting about this pattern is one of two things happens. You either break above 77 and you resolve this pattern to the upside, or you break below 74 and you resolve this pattern to the downside. One of those things is going to happen here, most likely in the near future. I would look for that direction to get a sense of where staples are most likely headed, and also keep a keen eye on the relative strength. That is the most important line when you're thinking about sector rotation. We need to take a quick break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using data visualization techniques to better quantify investor behavior. A couple quick comments before we get to our next segment, Shifting Stocks. We love your questions. We've heard from so many of you since we've been doing the show, and we very much appreciate your feedback on our shows, but very much appreciate your questions. What are you running into as you are trying to analyze charts, trying to use technical analysis and make decisions in your portfolio? Send us your questions via email. thefinalbar@stockcharts.com is our email address. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air in our next mailbag segment, which will be Friday of this week. Also, go to StockChartsTV.com. That is our on-demand platform. It is completely free and filled with fantastic information about the markets and educational content to help you make better decisions. You can go to StockChartsTV.com, use your email address to set up a free account, or on any of your mobile devices, just search on the App Store for StockCharts TV on demand. Let's go to our final segment today, shifting stocks. So we talked about the big picture. We talked about the S&P 500, sort of this choppy environment, the sloppy chop, as Sean McLaughlin described it last week. We then talked about sectors, and certainly the strength that we're seeing in some surprising places, really more defensive parts of the market like consumer staples. I didn't talk about utilities. I just want to briefly, I guess this is kind of an interesting start to shifting stocks, but just to start with utilities, you will find me not highlighting a lot of individual utility names on this show, probably ever. And I've learned that just over time from working with, for a lot of institutional money managers. Usually utilities are a defensive bet. Usually you go in there to look for yield and look for places to hide out. It's a lot less of a stock picking exercise and more of an allocation to more defensive parts of the market. Having said that, what's interesting is while consumer staples have been outperforming on a relative basis, utilities have as well since mid-November, but not as much, right? It's a little less of an upside follow-through in that relative strength. The relative strength is trending higher, and so I think you're seeing some movements there, but look at how, while the consumer staples sector is more in that coil pattern, more sideways, utilities are actually breaking down a little bit, testing the 200-day moving average over the last week. So one of my key risk-on versus risk-off metrics and an indication of risk-off behavior is a lot of people rotating into utilities. You're not really getting that. You're seeing utility stocks struggle along with everything else here. Today, by the way, and the reason why I caught my eye today, was the best performing of the 11 S&P sectors, but still down today, right? All 11 were actually showing some weakness today. We can start with Nvidia. We're going to get to as many individual names as we can here. Nvidia we highlighted last week, if I remember right, and I think as you're looking at this market and you're trying to make sense of things, trying to gauge how the broader market is doing, I think the chart of Nvidia could be a really important one to watch because this is a stock testing its 200-day moving average. When things are okay, when these are buyable dips, stocks like Nvidia pull back to key support levels like the 200-day moving average, like the 50-day moving average. They find support, buyers come in, and the price resolves higher. And you found that a lot of times in the last, really 18 months from Nvidia, right? You had moves higher, you'd have a consolidation phase, you'd test support, you would not break support, you'd rotate back to the upside. And that's the sign of a healthy market environment. What we're seeing now, though, is we're seeing Nvidia actually testing its 200-day again, and we've just recently put in a lower high. So the RSI didn't get above 60. The price remains below its 50-day moving average, now testing the 200-day moving average. I would want to see Nvidia break below 210 to turn more significantly bearish on this chart. Overall, it's not a bad chart. It's still a chart that looks like it has when it's pulled back previously, but it's really close to looking really negative. And when I think about this market, when I think about the broader message from a lot of individual names, charts like this I think are vital because they hold and things aren't that bad. They fail to hold support, and that tells you there's just an evaporation of buyers. Markets bottom out when buyers come in. This chart will tell you whether or not that's happening. I mentioned consumer staples. We talked about that consolidation pattern, what I'd call a coil pattern or a pennant pattern, maybe a symmetrical triangle pattern on the chart of the XLP. A lot of the individual charts in the sector are what fuel that chart looking like that. And KHC, Kraft Heinz, is a good one to look at. It's a pretty decent yield on a lot of staples names, particularly KHC yields about 4% right now. And you can see that the price has moved up to 40. So if you think about the chart of the XLP with the lower highs, the higher lows, and now wait and see mode, this is a chart that actually had a similar consolidation pattern. It's more of a flat correction, right, in terms of consistent highs but higher lows. And all of a sudden you can see over the last week, we have resolved that pattern back to the upside. While it has bounced off of the 200-day moving average many times over the last 6 months, it's now broken above that to the upside. My question for something like KHC, can it hold that breakout level on any pullbacks? There will be a pullback at some point. Can it hold 38, 37.50? That's the level of that breakout level. That would be a key question for me. But at this point, with how it's resolved to the upside, breaking out of that basing pattern, I would expect a return to the previous highs, which is around 43 on KHC. Staying within consumer, but to the other side, more of the offensive side of consumer, while things like Kraft Heinz are rotating to the upside. Tractor Supply Company is almost that chart flipped upside down, and you can see the TSCO is closing below its 200-day moving average today. The reason why I think that's an important one, it hasn't closed below its 200-day moving average since back here in April of 2020. That's how long TSCO has been just in a nice, consistent uptrend. At times not a great relative name because this is when a lot of other stocks were actually doing well. A lot of the cyclical names really did well during this period, but it's held in there pretty nicely, continued to make higher highs and higher lows for the most part, until the last couple months. Its most recent all-time high was around 240 in late December. From there, it's actually made a lower low and a lower high. Look at how it traded below the 50-day, tested that from below, and now rotating to the downside, closing below the 200-day moving average, closing below the January lows. That is not a great read on a pretty a chart that had been fantastic leadership for quite some time. And look at how the momentum has deteriorated over the last couple months since, as you might guess it, November. That's when a lot of these rotations started to happen. I want to highlight some of the other names to finish off our shifting stock segment. Some of the names reporting earnings this week. You had Home Depot before the open today, not doing well. Stock down almost 9%, a little bit more earlier. Finished down just below 9%. But similar to Tractor Supply Company, this is a stock that had a previous low, has now gapped below the 200-day moving average, breaking below its most recent support level. This is why the XOI was down so much, because names like Home Depot, which are big mega cap names in that space, are struggling quite a bit. Tesla not reporting earnings this week, but down 4% today. And again, lower lows and lower highs have happened. Just like you look at Nvidia and the 200-day, I would be watching that for Tesla as well. Other name I would mention, Mosaic, the agriculture space, the chemical space. A lot of these materials names have been in really good trends for quite some time. And they've been some of the better charts, making new price highs, new relative highs. Down a little bit today, and I don't mind that because overall I would argue the trend is still fairly constructive. You want to make sure that that holds support on any pullbacks. Leadership spaces, right? When the market starts to struggle, you want to see if those names are able to hold support or not. And I think that's a key chart to be watching this week. Finally, let's look at Etsy. This is the last chart we'll be able to get to. Reporting earnings, I think Thursday of this week. And I can't tell you particularly what I would expect from earnings because that's not my area of focus, but I do focus on the charts. And I will tell you in no uncertain terms, this is a chart in a downtrend, failing to hold support, failing to hold moving averages in a bearish momentum profile. The chart will tell you when buyers are coming in, and it is not indicating that just yet. Let us wrap the show, go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is that relative performance of offense versus defense. We look at consumer discretionary versus consumer staples. We highlighted the XLP chart earlier in the show today. We looked at that consolidation pattern while consumer discretionary, a lot of the biggest names like Home Depot and Tesla struggling and unable to hold support, really starting to be in a bit of a distribution phase. The XOY to XLP ratio had been rolling over since November. In the last couple of weeks, though, had been starting to bounce a little bit. And what concerned me about this chart and what we talked about last week is it looks like a bear flag pattern, which is when you have a big move lower, then you have a parallel move back to the upside, higher highs and higher lows on a much shorter time frame. The chart of the ARK Innovation Fund, ARKK, looks a lot like this and has also signaled much further deterioration from to continue on the downtrend that's been happening until now. Both of these ratios have now rotated and broken that support to the downside. This tells you risk off. This tells you investors are on the defensive side of that consumer space, and overall certainly indicating further downside risk for stocks. 3M is the second chart we're looking at. We didn't talk a lot about any industrials when we were doing our market recap, but I thought it'd be interesting to highlight one of them. This is a sector that's been struggling a little bit, and some of the key names have been struggling to hold support. This stock was down about 0.6% today. What concerns me about the chart of 3M is that it's been in a well-established downtrend. Look at how it's bounced off of the 38.2% retracement layer at the end of last year, broke down, bounced off of the 50%, and has gapped down through the 61.8%. As long as it remains below 150, this is a real negative chart showing distribution, right? Showing the inability of buyers to come in and buying pressure to alleviate the selling pressure that we're clearly recognizing. So from the March 2020 low to the May 2021 high, and I'm doing this on an unadjusted basis, so I'm just looking at price behavior. You're seeing a gap below that last 61.8% level. That suggests, all else being equal, from a Fibonacci perspective, it tells you that we have failed to hold our last support. We're heading back to all-time lows using that methodology. Well, I would be watching the momentum characteristics to see if buyers come in, but at this point, it's certainly in a distribution phase. Finally, the XLU. I have a series of charts every couple months. I do a chart, which I simply call the chart, and I have some key measures to watch. Things like breadth and sentiment, particular ratios to pay attention to, and the relative strength of utilities is one of those that I would include on there. The relative strength of utilities has been improving since November, but it's really not followed through as much as I would expect if the market was really deteriorating from here. I would look to see if relative strength continues to go to the upside, and if so, might be an interesting place to look. Folks, that is our show for today. Thanks so much for joining us every weekday after the close For the final bar for StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.